Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And it is a pleasure to have you on board with us today. My name is Seth Krussman, joined here as always, Ben Brayshaw and Dan Mickelon. Welcome, you guys.
How's it going, Seth?
It's good. Dan, can you hear me?
I can hear you well.
All right. I appreciate that. So, you guys, we have part two today of a show that, honestly, it's one of the shows that I enjoy doing, probably more than most. Why? Because it has to do with the market, it has to do with strategy, and it has to do with timing and all these fun things and indicators and just stuff that I really enjoy working with in the market. But more than that, it's just because I get to hang out with you guys for the next hour. So that's really the best part of my day.
Dan, I kind of see that as a privilege for him, too.
It is. It really is.
Whoa. We went in one direction. And thank you, Ben. I appreciate you blowing the doors wide open on this. And if you're joining us for the first time, welcome. We're glad you're here. We're going to have some fun. We're going to talk about personal finance from our perspective as financial planners. And as independent financial planners, one of the things we really focus on is called three-dimensional investing. And for that to happen, we need to be able to have access to the market and all different kinds of market pieces. And that's insurance, that's fee-based planning, that's brokerage. And I'd say consistently, more than anything else, is that you as our client or here with us on Money on Tap are the most important person in the room. Everything that we bring to the table has to do with you, your plan, your goals, and how do we accomplish that and have some fun while we're here doing this.
Yeah, that's for sure. Market timing is a good conversation because everyone thinks they can do it after the market's moved.
Right. Hindsight 2020, of course.
Easy to do on an upward slope, you know?
Yeah, no, it's like, oh, why didn't you invest then? Or why don't we do this? Or let's sell at the top next time. Oh, well, you know what? Pigs get slaughtered. That's the way it works in our marketplace. You know, if you don't take profits, if you don't look at that, because no one knows the top, no one knows the bottom, you know, creating those controls. We talked a little bit about that last week and some of the stuff. We're going to get into a little bit of what we do and how we look at it. And, you know, I think this is going to be a good conversation for people to kind of get a sense of reality and the down to earth, like the vulnerability of the stock market and the everyday, you know, deliberation we have about the market and looking at, you know, cues and stocks and looking for, you know, various everything to give you an indication of what's going on. And that's why there's an ongoing arbitrage on every financial TV show, radio event, everything. Everyone's always talking about, oh, this doing this, but then someone else says, well, this is doing that, and that could be an indicator of this, and everyone's got a prediction. So,
you know, this week has been a perfect time and setting for this topic. Because what we had, this is the week of September 20th, but we had Monday, massive drop in the market, right? We had this turbulence due to a bank defaulting in China, and it rippled through the market here. And we looked at, a 600-point loss on the Dow that day. And the days since, the market's been climbing right back up. So that point that we highlighted in the first show in the series about, you know, it's really hard to time the market because so often the very best days and the very worst days are so close together. This has just been a perfect illustration of that.
Well, and the market was down like 900 at the worst
at the low point. Yeah,
at the low point. I mean, that's 1,000 points on the Dow is not nothing.
No. You feel that one. That hurts.
So,
well, it definitely brings forward some conversations that we've been looking forward to having with you. and with their clients. And one of the nice things that we get to do here is be able to talk to you about the specifics of your plan and how the market is working for you in that capacity. So before we get going too far down the road on, is it time in the market or is it timing the market? And we're going to talk about all those triggers or the indicators that we look at or we think are significant and kind of share some of that perspective with you. It is time for Money in the News.
And first up today, we got an article talking about 4 unexpected ways to level up your IRA. And this comes to us out of Fox Business. And really interesting article here. And it was really pointing to a couple different ways that as you contribute to your retirement account, you can get a little bit more out of it, or how to best take advantage of it, using level up terminology here from right from the video game world. But one thing that was interesting is that there's a savers credit out there, and what it'll do is it'll give you an actual credit against your taxes due at the end of the year if you're able to make a contribution to your IRA, and that's above and beyond the deduction that you take for making a contribution such as that. And really the way it works is that it's based upon your income, but if you're making something less than $66,000 a year and contributing to a retirement account, a deductible retirement account such as an IRA or 401k, there's some extra credit out there for you, which is really interesting and probably an underutilized deduction there in the grand scheme of taxes that everybody should be aware of. And if you fall into that category, if you're making $66,000 or less but still are able to make a contribution, definitely take advantage of something like that.
Number 2 on that was significant, and this is the access to your IRA or the before 59 and a half, and the way that this is happening is through the Roth conversion. So the example that they use is a $25,000 conversion from an IRA into the Roth IRA this year, and then waiting the 5-year period to be able to have that access into that $25,000 anytime from that point.
Yeah, and additionally, you can really max out the Roth IRA, and they call it the mega backdoor here. But this contribution limits to a 401k, and as it stands right now, it's $19,500. Most people will be aware of that. But that's the deductible limit. All right, so that's the most that you can put away and still deduct from your taxes. But the fact of the matter is that you can contribute a heck of a lot more than that. In 2021, it's $58,000 or $63,500 if you're over 50. And those excess contributions beyond the $19,500 are just non-deductible contributions. But you can still set aside that money and you can still convert it to Roth should you feel that's to your best advantage. And that makes those dollars available for access sooner than the age of 59 and a half. So it's a way to create an additional fund of retirement dollars, but not have those rules and those access issues based on age attached to that portion of the contribution. So if you're in a position, kind of different from the savers credit, right? So if you're on the other end of the income spectrum and you can sock away that kind of money, you can create additional buckets of money to access for yourself.
And I feel like it's a good time to, say, but wait, there's more, and bring out our Ginsu knife commercial. But Ben, go for it.
Well, the Roth is really like it just has a lot of utilizations. There's lots of ways to get into it. It's kind of like this special club, like people want to get money into a Roth, so there's a lot of that, but people get nervous. And I like the idea that the Roth IRA can establish emergency fund kind of option, because a lot of people get concerned, like I got to put money away for some sort of problem or issue, but yet I want to put away for retirement. And the nice thing about a Roth is that your contributions that you make to a Roth, you can take those out anytime, and you don't have to pay penalties, you don't have to worry about that. And that's a great kind of peace of mind for somebody who's, because so many people struggle just trying to get off the ground. So a Roth is a really wonderful way to say, well, I need an emergency fund, which we recommend to everybody, but I also want to save for retirement. So if you feel like, hey, I'm really kind of just trying to get going, that's a great space to do it.
Yeah, there is more. As a matter of fact, there's several other Money on Tap episodes that we've released on this topic and others like the HSA, and there's just so many different strategies that you can kind of tailor and customize to yourself. The Roth is a great tool. So Heading down the road here a little bit further, we have from Kiplinger that there's dying careers you may want to steer clear of. And if you haven't read this article by Neil Godfrey, and that's from September 13th, 2021, he leads in with this jobs that disappeared. First paragraphs here is talking about or likening some of the jobs that today are disappearing to the carriage maker of the 1900s. And I'm sure the conversation would have been very similar to what he points out here is, the carriage maker is saying, oh, that automobile thing over there, it's a fad, and, it's going to get stuck and it's expensive, and, all the naysayers there. And maybe there's some of these jobs that you've felt this way about. I think I have. And as a matter of fact, one of them I feel very close to, which is the real estate agent. That's because, well, Kira, my wife, is a real estate agent and primarily focuses on the commercial real estate, but it is the technology piece there that has supplanted the real estate agent is moving quickly. And I'm really surprised, actually, that is a profession that more and more people, it's a growing profession that there's just a lot more realtor. Everybody knows a realtor. I know you know 5, right? So it's possibly one of those things that's going to be going away.
Well, I think I agree. I didn't see blacksmith on here, but I'm not signing up for that either, right? So,
no, it's got a comeback. I think that's actually one of them on the comebacks.
Is there a comeback list?
Oh yeah.
Well, maybe I'll still hold off. But I thought it was interesting. There's some real interesting. For people who are looking at. There's a lot of people looking for career changes. Ever since COVID, career change conversation has been, I would say, at an all-time high. So, if that's a place, that's something you're thinking about. This is the article for you. But real estate agent, truck and taxi driver, I thought that was why would a truck driver be? But autonomous vehicles,
the self-driving vehicles. That's the way of the future here. But there are a few surprises here. A lot of them, seem fairly obvious. You've got librarian, cashier. Those jobs. People are generally doing their research at home and not so many visits to the library. Cashiers checking out, you think that is something that technology is soon to replace. But they had things here listed like doctor. I know WebMD and all that's gone a long way, but still going to trust a professional somewhere in there, right?
Well, I think what they're doing is they're really going towards that CVS or the pharmacy conversions where you can go in and get your vitals and all that stuff taken a look at and, stand at the teller and get taken care of.
I think you're right. So I think that's the phase out a little bit, but I think it's, there's more PAs out there, more nurse practitioners, and, trying to mitigate all of that because the demand for medical is only growing. So I don't know that doctor's gone, but I would tell you that the number one thing on this list that I see is lawyer. I'm just like, how can we speed that puppy along?
I wanted to put a pause in that right there because it seems like actually, Ben, you're kind of like my doctor because I call you up and you tell me what's wrong with me all the time.
Oh yeah, there you go. Listen, I can break that down. I can give you guys all a laundry list. My wife has a laundry list for me though. That's for sure. Holy smokes!
Oh, she's a doctor too now, huh?
She's a specialist.
Oh, okay.
She's a specialist on Ben. So, but I think that the conversation of where's the world going? How's it doing? This is really relevant because even talking to my kids, 2 of them who are in college, just saying, what do you guys want to do with your life? But, my daughter wants to be in business. She really likes the idea of owning a business. And then my son is looking at, computer science. He's really engaged in that, but he's also doing a business major. But, I just look at this list and there's some things that I say, well, there'll always be a role for it, right? Like you could go to an old, museum kind of place and there's still going to be a blacksmith there and working in some of these places. I remember even recently with our kids, younger kids, they still have people that do these things. They learn these trades, but the demand is obviously not there, right? So it's something different. So, but some of these things like sports referee or umpire, who knows? But the technology is growing each and every day that supersedes potentially the call on the field, right? And so how does that come into play? Do we just eventually just They're gone.
Eliminate human error and just have it be a robocall. That's I guess probably depends on what end of the call it turned out, but I really like the idea of having that human touch and just let's accept the occasional bad call and let these guys do their job.
Yeah, I think that adds to the game.
Yeah,
I can see where that's happening in tennis more readily, just because
as long as the Yankees don't win.
Okay, there. That's enough out of that. There's the one that I had a different experience here recently was with banking. We actually, one of the iconic buildings here in Hillsborough, downtown Hillsborough, is a U.S. bank building, has been ever since I can remember. That's where my parents went. That's where I went. It is now sold, vacant. It's no longer a bank building. And where I've been doing my banking lately, the last time I was there last week, I walked in and there was a teller machine, and it's a kiosk. I walked up to the kiosk and hit the button, and a banker teller came online and was video chatting with me and giving me instructions of how to make withdrawals and deposits through this machine. And I think that would definitely help take care of some theft if there was issues with that going on. But it was different.
I had some kind of similar experience. I mean, I walked into the bank and there was a human there, an actual teller, and I went to do some very simple banking. But they turned me around and sent me to the ATM, and I was just sitting there thinking as I walked away, I'm like, do you realize that you're expediting the end of your working life as you turn me around here? And
that wasn't part of their training yet, Dan.
Yeah, I guess not. Maybe they get some kind of compensation for every person they send over that way. But I just walked away kind of smirking like, that really doesn't make sense for your own longevity here.
Man. Last but not least on our Money on Tap, Money in the News today.
A stretch of road in Michigan they're looking at building that will charge your EV as you drive over it.
Your electric vehicle. I'm guessing this is going to be like your phone. You put it on a pad, so it'll be hovering over this stretch of road that will be causing a charge.
All I can think about is those track cars that we raced as kids with the slot car, track car things. And
I think where this EV world is going is just almost endless in the industry development, because the demands are so uniquely different, right? And I think that's where the investing piece of this comes. I mean, we talk about some funny stuff. We talk about umpires and stuff. But all of this information, I think what people don't hear in our conversation is that they all lead us to conversations about how would we own something that we can make money off of. And I think the EV world is just almost an endless palette of opportunity. Like, who's going to build these roads?
What kind of components are going to go into that?
Is it cement? Or is it tar? Is it a whole nother substance? Does it, what kind of technology is involved? How much silver and gold is going to be involved in the evaluation? How much copper? Is it dangerous to be on? Is it going to have to be fenced in?
It snows in Michigan. How does that affect it? Wet weather on top, ice, snow, water.
We don't want to buy industries where, they're maybe phasing out workers where it will affect them. And we look at a bank and they can get rid of half of their employee staff. Well, the bank's going to become more profitable. The list goes on and on and on about the development, the number of lacking charging stations for people. If every car starts having a charger, it's like, look at all the people you see pulled over at gas stations. We don't have a tenth of what those are, and those are some of those charging opportunities.
Yeah, what Seth was talking about, the carriage maker fading away in the early 1900s as the automobile, made its climb into everyday life. What are the other ancillary businesses that supply regular cars and build regular roads? What's the impact of something like this on those guys? It's going to be significant. I mean, if they can do it for this 1 mile in Michigan, it's just a matter of time before that's every road across the country.
Yeah, and then that's just a massive infrastructure play. And then you're saying to yourself, well, they're not going to do it without everyone having an EV car.
It's another $5 trillion. Yeah. Load it up.
Another $5 trillion. Yeah. Hey, I actually want to say that there was fundamental profit. That was my takeaway there from you, Ben, as well as arbitrage. You used one of my favorite words. I don't know why, but I just love that word. And if you're wondering what that's all about, give us a call at 855-226-8551 or info@yourmoneyontap.com. We cannot wait to sit down, have a conversation around fundamental profits and arbitrage for you. We're going to take a quick break, and when we come back, we're going to be talking about market timing and some of the methods that have been around for a long time that people have analyzed and used and triggered, and all these different methodologies around the market to get in and out of the market. And so we're going to have some fun with that, and can't wait to get back here with you. Listening to Money on Tap. Don't go anywhere. We'll be right back.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms, where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
More Money on Tap in just a moment. On this Cliff Notes edition of Money on Tap, Seth and Ben look at the rising costs of caring for aging family members. However, there is a silver lining when it comes to tax time.
CNBC and it's Katie Doerr's CFP that is bringing to us that caring for aging family members can be very costly, right? So do not miss out on these tax breaks. So how many people are in that transition? Roughly, 19% of Americans provided unpaid care for an adult with health or functional needs in 2020, according to National Alliance for Caregiving. So of those people, there can be some significant tax breaks, and we want to make sure that you're aware and taking advantage of all those opportunities to lower some of your taxes.
This is a big piece for the millennial / pre-retiree. I mean, there's just so many different age brackets that are caring for family. If you're not aware of the ability to deduct some of these expenses, and that you probably could, the number of people who itemized their taxes and broke down those expenses to deduct them off their income dropped. Trump had raised the automatic deduction that we all get and doubled it. So married filing jointly went from like $12,000 to $24,000. Boom, you just get $24,000 deduction. Once you can prove that you have more than $24,000 in deductions, then you got to itemize and actually break those down. So we went from, 20 some odd percent of America's itemizing to like 7% with that tax law change. But if you have an elderly parent or, there's a relationship test around this as a qualifying relative, there's a lot of things that can put you over the deductions very, very quickly in the expenses and costs that you naturally incur and are not even thinking about.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Seth and Ben.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And today we are talking about market timing. The isn't it an age-old idea, or maybe not, of looking back at the market and saying, if I only would have known, I would have sold there when the market was at its high or fairly high, and gotten back into the market when it was near its low. It makes sense. People usually like to protect the profits that they're making or their investments, and that's one methodology around protecting your assets. It's called going to cash. It's using bonds or T-bills or whatever safer investment vehicles there are out there. Some people use CDs, but the idea that's intact here is having control and maintaining control over your investments and not having to be going through the market volatility. And last week, we brought a few different ideas to the table here, and we'd like to kind of pick that conversation back up with you. And to do that, Dan Michelin, would you please take the reins and talk about the 5 investor types?
Yeah, if you guys remember, we were going through an article that came to us from Schwab.com, and it talked about, does market timing really work? I mean, that was the thesis of the article. And they described for us 5 different investor types. There was Peter Perfect, who was the perfect market timer. He hit every investment at the absolute low. He bought into it and watched it appreciate to the absolute high each and every time. So obviously he performed the best. Next was Ashley Action, and she had a very simple approach. She got her check to deposit and invest, and she put it in the first day of the year each and every year. So as soon as the money came in, she immediately invested it all entirely. Then there was Matthew Monthly. He was the third type, and he did something that we refer to as dollar cost averaging, right? So he took his investment that it came in at the beginning of the year, and he invested proportionally 1/12 of it on the first day of each month throughout the course of the year. Next was Rosie Rotten, who, the opposite of Peter Perfect, just guessed wrong at each and every opportunity. Bought at the high, sold at the low, just really did not get this right. And then Larry Linger was the fifth one considered, and he was so nervous and so risk averse that as the money kept coming in, he just simply never invested it. And what was interesting to see here is, well, obviously Peter Perfect would have the best result, and he killed it every time, and he garnered the most return off of his investable dollars. But Ashley Action and Matthew Monthly were surprisingly close. In this study, it was taking a look at market performance going over a 20-year period from 2001 to 2021. So, for us, both of those approaches are things that we encounter and that we employ. It was interesting to see just really how close they were. And the other finding that was kind of striking is that how significantly and how easily the Rosie Rotten opportunity here, guessed wrong at every time but still stayed invested, outperformed Larry Linger, who just went to cash and stayed there. So I think those were probably the 2 most interesting findings, is how close the just dump it all in strategy was to dollar cost averaging, and how significantly different and better off you are in terms of just investing if you have the opportunity versus staying in cash.
I think when you break down these different pieces, everyone's asking us, hey, how do you invest the money? What do you guys do? How is it different versus what I do? And there's like 5 conversations inside that, right? So this is one of those. This is the conversation of how do we distribute the funds we receive into the market. And there is a lot of ways to do it. So there's at certain times, we'll receive funds and we'll be like, okay, well, you were equally weighted in the market already, fully invested. Well, we're going to go fully invested so you don't miss that time period. Because last week when we chatted about the 10 best days and the 10 worst days, and it's better to be in the market if you want to make money and you want to really be invested. That's history tells us that being in the market consistently is that way. If you're coming in with a cash asset, it's never been invested, you've been saving the money, we're much more likely to do dollar cost averaging. That would be right. That would be our number one go-to, guys. And we're not going to usually dump all the money in. So there's different times when that process takes place. And statistically, they both come out basically the same.
Very, very close.
Yeah. So when people ask us, well, how do you do it, and this is and so forth, that's complicated. But I will say that, we do, for certain people and certain types of asset classes and whatnot, especially when we're doing large cap value stocks or something like that, we do invest a portion of it, and then we'll look for a pullback. We'll look for some substance where there's kind of a threshold of strength in it, and we'll say, all right, when a pullback like that happens, we'll try to take advantage of that. And we'll leave cash in there. We'll be ungreedy that way. But we also let clients know that, hey, listen, we may miss a big rally in that. But in that kind of investment strategy, people are more concerned about preservation than they are about large gains. And
it has a lot to do, too, with the individual investor. Some people come to us and they're looking for the opportunity to buy individual stocks, right? So that's where we'll take into account, where is that stock at as an individual investment versus its history, and that's when we look for those opportunities to buy the dip, right? So you're looking for it to peel back a little bit, and then you can get back in versus, an investor who prefers to be just diversified, is looking at index funds, that type of a strategy, you really just want to get in the market with that.
Yeah, agreed.
One of the questions that I think you as a listener probably need to be asking yourself is, what kind of an investor are you? For one, we love to have a plan. We want to try to identify different ways that you work within risk, because that's ultimately when the market is not doing well. How you relate to risk in the market is significant in how you're going to be able to proceed with investing. Because the average investor, historically, it depends on the study out there that you're going to take a look at, but the average investor is somewhere around 2 to 4%. And there was a Dalbar's article out there that I referenced those numbers. And it depends on the time period. There's all these different places to kind of slice and dice this up. But if the market has, without, reinvesting of dividends is roughly, 8-9% over that period of time, the understanding here is that the average investor is not doing nearly as well as just being involved in the market. And I think that's the question that comes up for us is how do we get you as an investor to get into or engage in the market in a healthy way at a risk that you can sustain, and what are the different ways that we can do that? And dollar cost averaging is one of the ways that Ben and Dan were just talking about, which is just taking a part of the money and putting it into the market. It doesn't have to be equal. It just has to be kind of this activity with getting into the market over a period of time. And that's the dollar cost averaging, which, by the way, if you happen to have a 401k or some kind of a workplace retirement plan, is what you're already doing, because you get paid and a part of what that pay is goes into your 401k, and that immediately goes into whatever you've selected for your funds. And most of you have probably just used a target date fund. If that's you, please call, because it's probably not what you want to be doing. There's intentionality around that for you. And so that's what we're discussing, is what is the intentionality around the different kinds of investment strategies. So with market timing. And so it's fun. I told you that before we even got going, you guys, is that I really enjoy this topic because there's, investor psychology and all the different ways that people do what they do. And if you go out there and do the research that we're doing, it is a very interesting argument, or Ben, you said arbitrage of ideas that are happening around the market, because it's almost like you can cherry pick some of these different time periods to select what the outcome is, because and depending on how you dollar cost average into the market, you might get one kind of set of results versus just doing a lump sum investing.
Seth, you mentioned something there that just it rocks my memory of something Dan did years and years ago. You remember when we were evaluating the very best month to put money into an investment? And do you remember that? And there was you had a spreadsheet on it or whatever years and years ago. And it was everything from you could look at every day. He had done it on the side. It was just kind of interesting. But we were calculating
this is what we do for fun, folks.
Yeah, this is what we do. I know, but it was tremendously interesting, because these silly little back test things that we do, they just. I remember you were looking for it, you couldn't find it after you had.
Yeah. I remember what it is.
Yeah. So and just going through that and kind of evaluating, hey, if I were to dollar cost average on the 1st versus the 15th, and I was trying to annualize a return, what would be the best month, best day statistically to do it? And I remember we were chatting about that. Folks, there's just so much conversation around that, and everybody's doing analysis around that, except for yourself. The listener's not doing this stuff. This is what we do. I mean, we're weird. We like that stuff. It's just a challenge, I guess. I don't know. But as we break this stuff down and we try to evaluate it, we also know there's technical analysis that statistically seems to always be, something that's more right than wrong, right? Because there's never anything that's always right. And, I tend to lean significantly more to the dollar cost averaging. Seth, you bring up a great point. Everyone is already dollar cost averaging when they're doing monthly contributions to the retirement plan. And if you are using a time-dated fund, you need to pick up the phone and call us immediately, because that is something that I find to be significantly dangerous. And we actually all do. So that's got to tell you something. Because there's plenty of retirement options that you can choose inside your 401k that have nothing to doing with doing business with us, but are probably better choices. But as we kind of go through this, I want to bring up the article because there's an entirely different perspective on dollar cost averaging versus investing immediately. And this comes from an article on CNBC. And it's assuming that you're not just using a balanced portfolio. So let's take out the kind of idea of the balanced portfolio where you have stocks and bonds and everything else. And let's just jump into the idea like, let's say you have 100% stocks. You have a super high aggressive portfolio. And we go back farther in history. We go back all the way to 1950 and we evaluate every 10-year stretch. And we say, well, how does that look? Because the previous conversation where we had we're investing immediately or dollar cost averaging, putting money in every month is what dollar cost averaging means. And if you're just joining us, we're talking about market timing. The idea of doing both of those over the last 20 years is irrelevant. Doesn't matter which one you did. Statistically, you're just falling in the same bucket, essentially. Now, investing immediately means you did a hair better, but of no significant consequence either way, right, Dan?
Yeah, it was pretty much on the nose. There was maybe 1.5% difference between those two returns. So in that limited period of time, both of those strategies worked out well and eerily similar to each other.
Right.
And that was over the last 20 years, correct, for the time period?
Yeah, that's the last 20 years. But if we go back 1950 and we look at 10-year segments and we use a 100% stock portfolio, lump sum investing beat dollar cost averaging 75% of the time.
Yeah, that's 3 beats you threw out there. So, I mean, that's,
Well, it's 3 out of 4
really
times.
It's going down, folks. Ben said beat 3 times.
Yeah. Now, if you did bonds, it outperformed 90% of the time.
And not just outperformed, too. That the 100% equity portfolio had an average spread of over 15%, so significantly better.
But I think that brings us back to the point of like in this whole debate, which is why this is a 2-show series, folks. So you got to listen to the first one if you didn't hear that. But being in the market is better than timing the market, is what that says. Right? I mean, because we talked about the 10 best and the 10 worst market days and how does that affect it and all the history around that. And the truth is that if you miss those good days, you are up the creek because the good days are so big that it's extremely difficult. But as financial planners and fiduciaries, we look at this stuff because we're on our neck is on the line, right? We're here protecting and trying to help people, and we're trying to invest their money. We're trying to help them make money. And when we looked at the 10 best and 10 worst days, we were looking at 1990 to 2020 and to 2020. So that's the last 30 years. So if you go back to 1950, right, we're talking the last 70 years. So we're talking twice as much of a time frame. So clearly, from an investor standpoint, the last 3 decades or 2 decades in the different studies we looked at versus the last 7 decades, there's a significant change in how investing strategizes. Like dollar cost averaging is just catching up to becoming more of an equated value to investing versus if you look back historically, hey, you had 70 years total.
And that probably points to something that I think we all inherently realize is that there's more volatility in the market these days. That's, trying not to time it and just make sure you are participating is probably the way to go.
Yeah.
Hey, if you guys can't tell yet, I'm just dying to get into this conversation, okay? But we got to take a break. It's a breather for us, and because it's just too much good stuff, too much fun happening on Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about market timing or time in the market. We'll be right back. Hey folks, Seth Krussman, Brayshaw Financial Group is our company, and we bring to you Money on Tap. I say we, that's Ben and I. We have a lot of fun doing this show. And one of the things that we love about doing Money on Tap is that our goal for you to have access to the financial planning world. How do we think? What are we doing? What are we talking about? Raising the bar of your financial education. It's so critical. And that's what we're doing here. The other side of this is as well, we're financial planners. If you are looking to work with a financial planner, if you want to have that playbook for you to understand the important things right now and how you're going to get to your goals or how you're going to retire successfully, that's what we're doing as well. If you have $250,000 of investable assets, give us a call. It's free to you, and it is worth your time to pick up that phone and give us a call and discover what complete wealth management looks like. Ben and I are excited about the opportunity to partner with you and give you that financial plan that's going to make the next step so much better understood and get you where you need to go.
Now back to Money on Tap with Ben and Seth.
Welcome back. You are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And we are talking about time in the market or market timing, and we've covered so many different things so far, but we are going to land this plane on one of our favorite technical indicators around the market. So what do we mean? Technical indicator. What am I even talking about there? So there's all different measures around the marketplace. And, some of the most common are, volume. That means how much money's moving in and out of the market at any given day, any given time. Because the more money moves, right, the more that it usually indicates that, it's either people buying or people selling. And that dictates the direction that the market's going to head for us. So that's one of them that is always pretty apparent. And there's others, and we won't get into all of them, but a few of them are moving averages or revolve around moving averages or different measures of the moving average. And what does that even mean? That's, well, for instance, if you were to say take a 100-day moving average of an index, S&P 500, Dow, whatever you want to throw out there. I'm going to keep going. Russell's, Russell 1, 2, 3s. So if you're taking a look at the last 100 days of that market, okay, and you're averaging it, then that's going to give you that 100-day moving average. Okay, if you were to take a look at the 200-day moving average, that's same thing. 200 days. What is the average for those 200 days? Where does that put us as far as a plot on the map or the chart? And if you were to take a look at the difference between a 100-day and a 200-day, well, the 100-day is going to move much more quickly, right? Because we just have less numbers creating the average, so it takes, more market volatility to push that 200-day moving average up or down. Okay. And even more so the 50-day moving average, just going to be a lot more movement there. So one of the ways that we take a look or we enjoy, or we found that we're able to try to get some perspective around the marketplace is to see where is the 200-day moving average. Okay. And in relationship to that 200-day moving average, where is the market? Is it above that 200-day moving average? How high above that 200-day moving average is the market? Or vice versa here? Where's is it below the 200-day moving? How far, how long has it been below that 200-day moving average? So to give you an idea of what does that even mean and why would we be interested in this? So on the 200-day moving average, if the market is above that 200-day moving average, that's showing us or signaling us that the market is on an uptrend. It's moving higher. And if the market is below that 200-day moving average, then it's telling us the market has moved down. And so when we have a market that has moved above that 200-day moving average, okay, there's enough volume and there's enough sustained volume getting the market to that point that usually it's a good place for us to take a look at. Is this a good time for us to move or be in that market? And there's some there's a lot of data there to support that answer would be yes.
Yeah.
Right?
Yeah, I think the 200-day moving average is something that is very commonly looked at. The 50-day moving average is pretty common too. So they're always looking back 50 days, taking the averages through that time period and kind of calculating that. And I see it like a seesaw, right? So as soon as that seesaw goes down on one side and the market's not making money on that moving average, that's when people start getting real nervous. And, some of the things that we do are simply designed to move parts or all to cash in some of the holdings that we have. Now, that's not every holding. That's not every piece. That's not all of what we manage. But we do that with certain parts of the whole on how we manage, which is a little bit why we've mitigated some loss in a lot of areas and different time periods and things that have happened. And, it makes it easier to make more money when you have a little less loss during those time periods. And that actually, the 200-day moving average played really well into our favor during this last March and COVID and that experience. It played well for us in other time periods as well. And, you look back and there's another number of companies that help us do that fundamental, that technical analysis that we provide. And, it's really a wonderful thing to kind of know that you have something that's just going to create a cash asset when the market tanks, because I think paralysis is the number one problem for people when the market goes down, because they don't know what to keep and they don't know what to get rid of. But if you have a trigger that's sending cash into your account automatically, then when you hit bottom or you feel like you've hit bottom, you have an intentional value that you then want to deploy.
Yeah, it's all of these things are about, they're not meant to be clairvoyant. Nobody's got a crystal ball here, but what they do, these tools, is they increase our probability for success. And that's what we're really looking for in these indicators is, right, just because it's signaling one way or another doesn't mean that we're totally getting out of the market or totally getting into the market. But when you use these indicators to take a part of the portfolio to cash, what it does is it mitigates loss on that percentage of the asset that you've removed, right? So you've locked that in, you know where you stand, but it also keeps you primed for when the opportunity changes and when the time to get back in is. Then we can move forward with that and jump back in. So, using tools like this increase our probability for success and help us do that whole notion of, sell high, buy low.
Right. And I think the other thing that's really interesting is just like, well, that's great and all, Ben and Seth and Dan. I really appreciate your interest in the 200-day moving average and all of that. And why do we think that that's valuable? Well, when we look back historically, that actually plays into a lot of favor. Like, for instance, in between early 2000s and 2003, right, the market was on a massive down tear. Well, if you had the 200-day moving average in your holdings on the S&P 500, well, you know what? You would have moved to cash at some time in the very, very early 2000s. Oh, 2008 and 2009, does anyone remember losing money then? I know a couple people that would probably walk through the door and say, yeah, I got my shirt handed to me and, that's all I had to live on. I've had people coming in my office crying, working with another advisor saying, can you help me? I got this left and I'm trying to figure out how to retire. I just lost 30, 40, 50% of my money. Like that. People got really burned in 2008 and 2009. Guess what? Moving average would have solved a good chunk of that problem. You look at COVID, you look at, there's a number of times. Now, getting in and out of the market is a good question, right? So some people use a 200-day moving average in. Some people use it to also go back in. We've done both. We've looked at the market, and we actually use basically an active perspective here of evaluating whether or not we want to manually move back into the market or if we want to allow the technical analysis to move back in. And we've benefited and we've missed out on other scenarios doing different things. So we try to look at the indicators and say which system do we want to ride. Now, information is very interesting. And I think, guys, one of the problems we have is there's just too much information. There's almost more information than we know what to do with, and trying to boil it all down. I think for everybody that listens here, if you've ever made syrup, if you've ever taken sap out of a tree and you've got buckets upon buckets upon buckets, and this is the farm boy in me speaking, right? Okay, so, you've got buckets upon buckets, and by the time you're done, you're like, I filled this tiny bottle boiling this thing for 3 days. Okay, so you don't have a lot, but we have to take all this mammoth amount of information and we try to get it down to where we want to be. That's a hard thing to do. But technical analysis seems to help on the 200-day, and I like it. I think it's strong. I like the time period. We've looked at historically at the 250, the 150, the 100, the 50-day moving average, and 200 seems to be the call I like the best right now.
There's several other signals out there that we've taken a look at as well. Consistently, we're looking at some of these, and one that I do like, but it has the tendency to kind of trigger too quickly, and the whipsaw effect of the market can take effect, is that 100-day moving average with a 50-day moving average. When that 50-day moving average crosses over the 100, that trigger to cash, going into cash, has been one of the methodologies out there. And if you back test a lot of this information, you'll start to see where some work and where some miss. And like Ben said early on, there is no one-stop fix for everything.
Yeah,
there's just going to be places where it doesn't work, and there's going to be places where it does. Now, if you can avoid some of those 2000s and 2008, 9s, that's significant.
Seth, I think we should explain whipsaw a little bit.
Oh, sure.
I think the thing is that when people invest, if you're getting in and out of the market and the stock market's tumbling down and then it goes back up like it did this last week, tumbling down hard, and if you're getting out and then all of a sudden the market goes back up and you're like, oh shoot, I should have been in, and then you invest, you lost all the money and then you missed all the gain. That's a whipsaw. The market's swinging left and right, and that's why we try to use long distance moving averages so that we're not jumping out of the market. We're looking for a downward trend. We're looking for where people are slowly or intentionally reducing their positions in the market. And the market is seeing a natural, or what appears to be a natural, exiting strategy for more sales.
Yeah. There's some great work out there. Daniel Kahneman was the winner of the 2002 Nobel Prize in economics and wrote a book in 2011, which is Think Fast and Slow. And this has to do with risk aversion, and everybody's involved in this. And it's some of the technology that we're using on behalf of our clients to help them understand the relationship that they have with risk. And if you're interested in that, it's for free. You can go to our website and just look under the resources there. There's a free risk analysis for you. And then you can find out where you're at in your risk in relationship to the market. And maybe you're too risky these days. And maybe you need to take some of that off the table, or maybe you need to put more on. Either way, we're here to help, and we're so glad to be able to spend some time with you today talking about how we take a look at the market and the techniques that we use to get in or out of the market when, timing the market, or, not timing the market and dollar cost averaging into the market.
And Seth, in addition to that resource that we have on the website, a service that we offer is something that's a little bit more tailored to your individual holdings. So if you send us a statement of your 401k or your brokerage account or wherever your investments are held, one of the things that we have here is a tool that will actually evaluate the specific holdings you have and take a look at your overall portfolio and give it a risk score that, with the hope is that matches up with the risk score that your personality profile resulted in. But what we often find is that's not the case. You're either taking on more risk than you think and are comfortable with, or less. And either way, there's something interesting there to be discussed and to take a look at so that we can get your portfolio potentially more in balance with the risk tolerance that you naturally have.
Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You can also find us at yourmoneyontap.com. Thanks, folks.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.